You watch the price climb steadily for hours. You wait patiently for confirmation. You enter the trade, and almost immediately, the market suddenly collapses. This frustrating cycle happens because traditional tools, like standard MACD lines, are inherently reactive. MACD stands for Moving Average Convergence Divergence, which is a trend-following momentum indicator calculated by subtracting a long-term moving average from a short-term moving average. But relying purely on its lines crossing means you are looking in the rearview mirror. By the time those lines cross to give you a buy or sell signal, the bulk of the move is already finished. You end up entering the market at the exact moment large institutional players are taking their profits and exiting. Surviving these markets requires a shift in timing. You have to anticipate the death of a trend before the actual price drops, rather than waiting for lagging indicators to tell you what already happened. That is where the MACD histogram comes in. It sits quietly beneath the main price chart, acting like a diagnostic engine that tracks the invisible forces pushing and pulling the market. Price action only tells you where the market is right now. The histogram, however, acts as a leading indicator, revealing exactly how fast the underlying momentum is accelerating or decelerating. This chart shows the core mechanical calculation of the MACD indicator. The histogram is simply a visual measurement of the exact distance between the faster MACD line and the slower signal line. When you see those bars growing progressively taller and turning bright green, the gap between those two lines is widening. The bullish momentum is actively accelerating. Pay close attention to early warning signs. The price trend might still be moving upward, but if the histogram bars shrink and shift to a dark, muted green, momentum is decelerating. You get a distinct rounding top shape. That rounding top tells you the market is taking a breath. But bullish energy that drove the initial rally is rapidly dissipating, even if the candlestick on your screen is still inching higher. Monitoring this specific slope gives you a proactive visual cue. You can tighten your stop loss, secure your profits, or prepare for a short position well before standard MACD lines ever cross. This leads us to bearish divergence. It is one of the most reliable signals we have for identifying when a current trend is completely exhausted and a reversal is imminent. This chart shows how divergence plays out. On the top half, we have the required price action. The market rallies, dips slightly, and then pushes upward again to establish a new, higher peak. Now, look at the histogram's hidden data on the bottom half. During that second, higher price peak, the histogram does the exact opposite. It forms a significantly shorter peak. You have a direct mathematical contradiction. The price is charting an upward slope, but the underlying momentum is charting a downward slope. That contradiction reveals the truth of the market mechanics. The buyer's second push higher lacked conviction and volume. It creates a trap for late-coming retail traders right before the bottom falls out. Divergence exposes when the price action is lying to the broader market. Spotting this structural weakness gives the proactive trader a massive informational advantage. However, trading a histogram divergence in complete isolation is dangerous. Extended divergence can persist for long periods while the price continues to climb before the actual reversal triggers. To trade safely, you need confluence. Confluence is the practice of combining multiple independent technical signals to confirm a single trading decision. You have to align the histogram's divergence signal with the broader structural context of the market. A bearish divergence warning transforms into a high probability setup only when that second price peak perfectly aligns with a major daily resistance zone. The price is hitting a ceiling exactly as the momentum dies. Then you look for your final trigger, a specific bearish candlestick pattern visually confirming the weakness on the chart. A shooting star, a candlestick with a long upper shadow and a small lower body, is a perfect example, showing buyers tried to push the price up but were overwhelmed by sellers. Systematically layering these filters, momentum, structure, and price action, eliminates the noise of the market. It leaves you with only the highest probability trading setups. Even with the best setups, no indicator guarantees success. Strict risk management is your only real safety net for long-term survival in trading. There is a mechanical rule for stop-loss placement on a bearish divergence trade. A stop-loss is an automated order designed to limit your loss by selling an asset once it reaches a certain price. You place it just above the highest price peak to protect your capital if the divergence signal fails. And always follow the golden rule of position sizing. Never risk more than 1 to 2% of your total account capital on a single trade. Mastering the MACD histogram allows you to move away from reactive trading. You start anticipating the market's next move. Practice spotting these early momentum shifts on the FXNX platform today and see what others miss.